What if I told you that there are hacks in the Indian stock market no one will tell you? Your advisors, your banks, your brokers, nobody is going to tell you because it's not in their best interest. So in today's video, I'm going to reveal 7 such hacks that will help you save lakhs and lakhs of rupees over the years. Hack 1. Always prefer direct mutual fund over regular mutual fund. Let me tell you why. For example, if you had invested a same sum of money on quant small cap fund growth and quant small cap fund direct plan, okay, so one is regular, one is direct. You see the expense ratio on the right, it's 1.59% for a regular, and for the same fund the expense ratio is just 0.71 on a direct fund. What does that translate to? So if you do a SIP, onto the left hand side, what you see is at a expected return rate of 15% on both the sides and a time period of 15%. So if there is a difference of 0.9 that we see, the difference is about 8 lakh rupees over a period of 15 years. And that is the difference between 92 lakhs and being 1 crore. Hack 2. Arbitrage opportunity. So what does we mean by arbitrage? So in the Indian stock market, there are primarily 2 exchanges. One is the NSE, one is the BSE, right? And there are often times that you will notice that in a stock, there is a small price gap between the BSE listed price and the NSE listed price. That is what an arbitrage opportunity is all about. So you can buy a stock from one particular exchange, the one which is cheaper, and you can sell the same stock to an exchange which is offering you a higher price. So let's look at an example of Keynes Technology. So this is a stock that you see, there's a 5 rupees difference in terms of prices, selling prices across both the exchanges. So if you can pocket this 5 rupees over a period of time and multiply that with 10,000 stock, it's a very sizable number, right? So this is a very small, simple hack which everybody can definitely leverage and get the best out of opportunity. Hack 3. 200-day moving average. So 200-day moving average is something that institutional investors, FII, FDI, and our domestic mutual fund as well, they track it very closely. It's like a psychological level for them. So if the stock trades higher than the 200-day moving average, it is considered a good entry point. And please be cautious in case it breaks your 200-day moving average. So this is a very simple hack that can help you in identifying the entry point of a stock. Hack 4. Tax loss harvesting. So tax loss harvesting is a very simple strategy that everybody can make the best use out of. So imagine there are 2 stocks in your portfolio. One, you have a 10,000 rupee gain, and the other, you have a 10,000 rupee loss, right? And in the current situation, you do not want to sell any of them. You want to continue holding your positions in both the stocks, right? So what you could do, and if it's towards the end of your financial cycle, right, which is it's around 31st of March, it's a recommendation that you sell both the stock so that you can offset the profit to that of a loss, right? In that case, you don't have to pay any tax on that particular financial cycle, and on 1st of April or later, you can again buy both the stocks and continue holding it, right? So now extrapolate from 10,000 profit, 10,000 loss to maybe 10 lakh profit and 10 lakh loss, okay? So if you offset it this way, the profit that you would have had on a 10 lakh, right, that would subside. And for the loss as well, right, you can again buy the same stocks at the same price just a day later. It's absolutely legal way to save your money. This is something that so many people are doing it, and I highly recommend you to consider this as well. Hack 5. Dollar cost averaging. What do we mean by dollar cost averaging? It means you average out your buying price of a stock when the stock is at a lower value, average value, and high value, so that over a period of time it averages out. Now we all know that in today's market, INR depreciates about 3.5 to 4% every year, right? And if I look at the volatility of any index also across 1 year time frame, generally we see plus minus 15%, which means it toggles from a minus 15% range to a plus 15% range, generally over the years. So the recommendation over here is that you can buy the stocks and buy the mutual fund at the same day, on the same day, over the period of 12 months in a year, right? On one particular day, let's take an example, 13th, right? It's a psychological day as well. So 13th, if you buy, you will buy one at a maybe at 1010 rupee, one at a 980 rupee, one at 1000 rupee. So over a period of time, your buying price averages out. So this mode of investing, the SIP mode of investing, is something that is very crucial in tackling your market volatility, right? Hack 6. Using your collaterals instead of taking a personal loan. So this is something, you never know your circumstances. Tomorrow, there might be a need for an emergency fund. And maybe the current emergency fund that you hold is not big enough for you to suffice that. So in a normal world, what you will do, either you will ask from somebody or you will take a personal loan. In today's day, a personal loan is anywhere between 12 to 15%, correct? It can be even more than that. But every broker, almost every broker is giving you a cut to your investable amount, and you can use that as a collateral to take margin money, which will be around the range of 9%. So for example, today in your Zerodha portfolio, your stocks plus mutual fund is about 10 lakh rupees, right? So the stock broker will have a haircut to it, right? So there is a margin for it. So the margin is maybe for a 10 lakh investment, the margin they are willing to give is a 6 lakh, correct? So 6 lakh is the loan amount that can be dispensed to you, okay? It can be disbursed to your bank account. And for that 6 lakh that is disbursed, that is your personal, that is the loan amount. Over that, you have to pay about 9% of interest, which is a very simple thing because you are saving 4% on the interest. That's one. You continue to hold on that stock or the mutual fund because you are not breaking it, you are just using it as a collateral. So the price appreciation till the time you give back the entire principal, right? You can continue to enjoy that as well. And the interest rate is lower and you don't have to take any additional loan for it. Neither you have to break the current portfolio. So this is a very useful tip for an emergency like situation. Hack 7. Efficient mutual fund redemption. So every year there's a mutual fund that you are buying. The plan over here is that, and your mutual fund will grow over a period of time. The easiest way to save money on your tax is by booking profit before the end of a financial year. Because every financial year they give you 1 lakh of profit. It's something that you don't have to pay any tax on it. This is absolutely called proper tax planning, not tax evasion. I'm not going to teach you tax evasion. This is tax planning. So 1 lakh of profit in each financial year from your mutual fund is tax free. Over and above that, whatever your profits are, you have to pay either short-term capital gains tax or long-term capital gains tax. So the best thing that you can do, for example, you have a lump sum, you have invested 10 lakh rupees. In today, it is going to 12 lakh. So you can sell it, again buy it on 1st of April. So 2 lakh will your profit, 1 lakh will be tax free. Over 1 lakh, you have to pay either a 15%, 20% tax, right? But what if you have not done it over a period of 20 years? Maybe that 10 lakh would have become 1 CR. So your profit in that case is becoming 90 lakhs, right? So 10 lakh is becoming 1 crore maybe. So 90 lakh profit. So you have to pay tax on the entire 90. lakh. Instead, every year if you do it over a period of time, that 1 lakh, 1 lakh, 1 lakh every year that you can save, it's totally tax free. So this is a very simple hack that most of you guys would not have known. So this is something that I would recommend you guys to closely monitor and execute it for your portfolio. That comes towards the end of the video. So today we learned 7 hacks that will help you save lakhs and lakhs of rupees over a period of time. Just to sum things up, hack 1, we covered direct versus regular mutual fund, wherein direct mutual fund is always preferred. It saves you lakhs in terms of commission and expense ratio. Hack 2, arbitrage opportunity, which means you can pocket the difference between the two exchanges, BSE and NSE. So before you buy any stock or you sell any stock, it is recommended that you check the price across both these exchanges before you execute them. Hack 3, the 200 DMA strategy. In this, we learned that closely monitor the price of a stock for entering and exiting and see how much the variance of the current market price with that of the 200-day moving averages. Hack 4, tax loss harvesting. It means you can offset the profit of a stock or a mutual fund with that of the losses of a stock or the mutual fund. Hack 5, dollar cost averaging. This is indexing on the SIP mode of investing, which averages out your entry point or the buying point of a mutual fund or a stock. Hack 6, use pledging or your portfolio collateral instead of taking a personal loan for your short-term cash requirement. Hack 7, tax efficient mutual fund redemption. So while you are doing any kind of redemption on your mutual fund portfolio, try to do it in the same financial year, which is before 31st of March. And you can use the same trick to buy the mutual fund again on 1st of April or later to ensure that you can the best use out of the 1 lakh profit that you would have paid tax on. So these are the 7 hacks that I am telling you in today's video. Among them, 1, 5 and 7 are the easiest to execute. Do let me know if you had known any of these stocks, and please comment down that which one are you going to execute first. That's it guys, thank you so much for watching the video. Until then.